Okay, welcome to 10-7 Explained. It's asking us to make the closing entries, and I've already taken the liberty to draw it all out into T accounts so that we're not using these different general ledger accounts. From there, you should be able to extrapolate all the information you need to do a post-closing trial balance. So let's just, number one, let's go through and close the revenue account that has a $16,300 credit balance. We're going to do a debit to that. So there's our debit. Here's our credit, 16,300. The second account that gets closed is the expense accounts. Well, there's four of them, and it looks to me like I'm missing some of the balances, so we'll go back in and put the rent expense balance of $4,000 debit, and the utility expense of $1,900, and that gets us back up to speed here. So if we take these accounts, and these is a compound transaction, and we're going to take the sum total of all of them and bind them up and dump that value into the income summary. So $3,000 debit, $3,000 credit, $1,100 debit, $1,100 credit, $4,000 debit, $4,000 credit, $1,900 debit, $1,900 credit. So these are our credit transactions, right? So we see our credits. So we're going to have it, when we journalize it, four separate lines for one line per expense account. We take the sum total of all of those, and we're going to come up with, let's see, 3, 4, 19. I'm going to say we come up with $10,000. So that would be 10,000 even, and that is going to be 10,000 debit. So there's our second transaction. Now the third one that has to get closed is the income summary, and we know that the income summary gets closed into the capital. We take the difference of the two, because there's no such thing as an increase side or a decrease side. We just take the difference of the two and put the balance on that side. So we say 10,000 is how much different than, say, 16,300? Well, I'm not a rocket scientist, but I could at least do that in my head, right? So we would say the balance for that account is going to be $6,300. Well, if we want to close it with a credit balance of $6,300, we need to do a debit transaction of $6,300. There's our third account that gets closed, and we're going to close that directly into the capital. Well, if this is our debit, here is our credit. Beautiful. Closes the income summary. One last account to close. That's a $4,000 debit balance, and the withdrawals. Withdrawals get closed directly into the capital. So if we have a debit balance, we need to do a credit transaction. There's our fourth account that gets closed, and we're going to put that $4,000 balance, 4,000 credit, 4,000 debit, and that is our fourth transaction. That closes out all of these accounts. So what's the second part of that question asking us? Well, it's asking us to prepare a post-closing trial balance. And since we have all the information for this journal right here, all these, I'm going to see if I can just get rid of it, and then we can call up the rest of these accounts. Well, that's simple enough. So let's take this for a second. Let's work on the permanent accounts first, and then we will come back to those temporary accounts. So if we have a cash and bank account, well, what is the balance of the cash and bank? Looks to me like we're probably a little high up on the screen there. Maybe I can bring that down. Cash and bank balance is $12,000 debit. And so we're just going to simply go down, right down the list, because every single permanent account is listed on the post-closing trial balance, whether there's a zero balance or not. And in this case, I believe all of them have something, so it's going to be easy enough. Normal balance side, right? The increase side. So you can see 12,000. That's not very bright. We need to brighten it up. 12,000, 600. Where am I getting these numbers from? Right here. 1,000, 900. Office equipment, making sure we're still in the same line up here. 5,500. 7,400. Computer equipment, 7,100. Hiking equipment, 15 grand. It's going to take a bit to crunch all these. And rafting equipment, 30,000. Alright, payables. Well, credit side, payable A1 is 12,000. Payable peak equipment, 9 grand. 9,000. Let me make sure I'm doing that right. And there's another payable down here for Premier. That's 6,000. All right, simple enough. Well, we're not done yet because we need to know what the balance is in the capital account. Well, we'll go back to our graph, our drawing here, and this is the account that we're dealing with. All the temporary accounts have been dealt with already. So we're going to say, what is the difference between the decrease side and the increase side? Well, if we take, that's 56,300 minus, let's say, 50,200 plus 6,300 minus the 4,000 gives us a capital balance of $52,500. And that is the number that's going to go right on to the post-closing trial balance. $52,500. Now, if you were doing it on pencil, you would put a single line, and of course, you can see that it's kind of there already, a double line for the double rule. If we add up the total of the liabilities plus the capital account, or the equity account, we're going to come out with $79,500. And if we were to go through the trouble of adding up all the asset accounts, you're going to come up with $79,500. So what is the balance of the account, of the capital account? Well, of course, you can't answer that second question, the analysis question, unless you have already done the post-closing trial balance. So the answer to this question, which you're going to see, is kind of redundant because you've already figured that out. After the closing, what was the balance? Well, 52,000. See, it does that. $52,500. And that got a little sloppy there for a second, didn't it? Oh, get rid of that. So $52,500 is the balance in the capital after all the closings, and that concludes 10-7 in less than 9 minutes. So that is 8 minutes and 40 seconds.